Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from Saturn Oil and Gas, Inc. Please note you can submit questions in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Kevin Smith, VP of Corporate Development of Saturn Oil and Gas, Inc., which trades on the OTCQX Best Market under the symbol OILSF and on the TSX under the symbol SOIL. Welcome, Kevin.
Thanks, Matt. Thanks for hosting. And thank you all for joining us today here with the Oil and Gas Conference. Saturn Oil and Gas is a Canadian-based conventional oil and gas producer. We're in the prairie regions of Canada, western provinces of Alberta, Saskatchewan. So typically where we conduct our business is in the farmers' fields. And a typical installation here is we use a small piece of land from the farmers and then return it in pristine condition when we're done. So no open pit mining. We're not in the oil sands business. And really we try to make a very small footprint and produce a lot of light oil. We have been growing at a fairly rapid clip lately. This caught the attention of the Report on Business magazine, October edition. It's a publication of the Globe and Mail, which is Canada's largest newspaper. They ranked us as the 18th fastest growing company in Canada. A nice accolade, and I guess that puts us as the fastest growing oil and gas company in Canada. And so I'll walk you through how we got there. And along the way, we've delighted to increase our listing to the OTCQX in the US. And as well, recently we graduated to the TSX main board, where we got our start on the TSX venture. So speaking of the growth, when I joined the company in early 2021, we were a humble 200 barrels a day of light oil production. And in the last 2 years, we've been able to ramp that production up. This would be the typical Canadian hockey stick growth curve, where we've now touched just over 26,000 BOE a day of oil and gas production. We're about a little north of 80% of that being light oil and liquids, the high margin hydrocarbons. And so what that means from us is cash flow. So for this year, we're looking to do about $375 million Canadian, and most of the numbers I talk about in this presentation will be Canadian, in cash flow, EBITDA. And I think we'll beat that next year. And so that equates to about $2.25 Canadian per share. I think we're trading right now about $2.73 Canadian. So we're about 1.2 times cash flow. It's a small multiple, but I think we got time for the market to get it right. We got over 15 years of drilling inventory on hand that we can sustain our current drilling pace. So we've got quite a bit of inventory in hand that we'll be developing over the next number of years. So one of the drivers of the growth is acquisitions alongside of our pretty impactful development drilling program. The most recent acquisition we did was this year. 7 months ago, we picked up a private company, also based here in Calgary, where our headquarters is, called Ridgeback Resources. It's a nice, small, heavily weighted to light oil production company. We bought it for $525 million. The company itself at the time was doing a run rate of net operating income north of $300 million. So we're able to make this acquisition at a pretty attractive cash flow multiple of 1.7 times. This added 17,000 BOE a day of 71% light oil and liquids to our production mix. That was a 140% increase to our production. So a real game changer for us. We had to raise some significant funds for ourselves to make this acquisition on a cash in a partial share basis. So we look to our lender. We have a family office out of New York that is lent us now money 4 times to make acquisitions. So this is the 4th one. They extended our credit by $375 million. So that covered about 70% of the acquisition price. We also went to market and added a $125 million bought deal. It went very quickly. We're quite happy with it being over 2 times oversubscribed, and it brought in some great new shareholders for ourselves. GMT Capital, institution out of Atlanta, Georgia, another family office. They backstopped the deal and added in roughly $68 million lead order to get this deal across the line. So we welcome them as a new shareholder. Another notable investor is Libra Advisors out of New York. They've been with us since 2021 and saw this as an opportunity to add to their $10 million stake. So they added another $30 million into us. So I understand GMT's been back in the market buying additional shares. They're up at about 25% ownership in us. So we got some relatively large U.S. shareholders and some relatively large expectations as well. So looking at our capitalization, we got about 139 million shares outstanding, where we're trading at $2.75 today, thereabouts, or call it, we're just about $2 US. And we're looking forward to breaking through that mark. That puts our market capitalization about $380 million Canadian. You'll call that about $275 million US. And right now we're taking this large amount of cash flows we get from producing light oil to paying down our acquisition debt as fast as possible. So about 60% of our debt is directed toward of our cash flow is directed toward debt repayment, and so we're paying off our loan about at $25 million Canadian per month. So $25 million per month. So it's the debt is coming off quite quickly. In fact, we think we'll be down to about $450 million of debt by the end of this year, down to $250 million of debt by next year. So we're looking at about $200 million on a run rate for free cash flow every year. So if we, to its logical conclusion, that would make us debt free in about 2.5 years. We think debt's a prudent part of the balance sheet. So somewhere in the next coming months and into next year, we'll likely reorganize our debt, take off the amortization schedule that's a little bit dramatic at this point, and make it a permanent part of our capitalization. And at such time, then we'll have to figure out what to do with the additional $200 million plus of free cash flow going forward. Of course, the board is evaluating a dividend, share buyback, and additional CapEx spending as alternatives. So we have been adding production at a time when the oil prices has been increasing. So our timing couldn't have been better. And so what we've been also focusing on is not just the great price of oil that we get, but how much of that do we keep as cash flow. So we've been rationalizing our cost structure. So in 2021, we were about $28 Canadian as an op cost. We're able to bring that down in the first half of this year to $22.50. So that's about $5.50 that increases our cash flow despite what the commodity price is. Also on one of the biggest deductions we get at the field level is royalties. We've gone from about a 15% royalty in 2021, where that's now, we've dropped a third of that, and we're about 10% in the first half of this year. So what that's allowed us to do is increase our margins. I'll note that in 2022, when the price of oil, WTI, averaged about $95 for the year, we're delighted with it. We're able to put up a $43.82 net back. When oil fell here in the first half of the year, only averaged about $75 first half of 2023. We are still able to put up a $44 net back, and a lot of that is based on the fact that we have lower op costs, lower royalties, and there's a bit of a Forex in there as well. So we've been maintaining our net backs and look to even cut those costs going forward to make sure that we get a lion's share of the revenue from these high oil prices. So as it sits now, like I said, we're in Alberta and Saskatchewan in the farming provinces here of Canada. From looking at the map on the bottom right, from east to west, the Oxbow asset, that's our biggest cash cow. We're just over 11,000 barrels a day of oil, liquids, and natural gas production, predominantly all light oil in this area, and certainly our cash cow. On the Viking side, that's just below 5,000 barrels a day, again, light oil in the Viking area of west central Saskatchewan. And then what we've added with this Ridgeback acquisition is some phenomenal Alberta properties. One itself is this Cardium asset. It's about 9,000 BOE a day, a little bit of natural gas in there. It's a company maker itself, large contiguous land base and fantastic drilling opportunities. So we welcome that as our third core area. We also have some areas in northern Alberta. We're actually drilling that right now up in the Kaybob Montney area. And so another great part of it, it's be our fourth core area, but it's a little bit smaller at this point, and we'll be looking to grow that going forward. So looking at the cash flow side, Q2 of this year was our big record. We hit $95 million of EBITDA. It's over 400% increase year over year. I think we'll beat that here in Q3 and Q4 going forward. We're looking for north of $100 million Canadian of EBITDA from our current operations for the next several terms. Diving in a little bit to the maps here, speaking about our Oxbow, the big cash cow that we have in southeast Saskatchewan, it butts right up against the border of Manitoba to the east and North Dakota to the south. So what you saw here is we added in on the western side of this map this Viewfield property, came in with the Ridgeback acquisition, increased our production in this core area by 70%, fits in very nicely. We've consolidated the two operating headquarters into our Carlisle office, and really driving home some great synergies. We're dropping our op costs, we're dropping our G&A in this area, and we currently have 2 rigs running full out for the rest of the year, developing the properties here. We have 583 booked locations, and that's probably enough to last us the next 15 years. Key to this area is we control the pipeline network. We have 4,000 kilometers of underground pipelines that take the oil, the gas, and the water from the wellhead, re-inject the water back into the ground, and send the oil and gas off to market. So the key to operating this area is keeping your operating costs low, and it's key to control the infrastructure here. So we truly are the big fish in the small pool in this little corner of the province of Saskatchewan. We just a couple weeks ago put out our most recent drilling results. We tend to, every time we have a batch of drilling that has over 30 days of production data, we report back to our shareholders. This group of spearfish wells in the southeast Saskatchewan was the best group of wells we've drilled so far. The IP30 was over 100 barrels a day. There's a little bit of a spaghetti plot in the bottom that kind of shows each of these wells. And what was nice about it is that as they were cleaning up, the production profile over the first month was actually increasing. In the oil and gas business, we're always faced with declines, and it's nice to add a batch of production that's at a lower decline level. We have over 35 locations left in this area. As you can see on this map, the blue sticks will keep us busy for some time, and we'll be back at it early next year, back in the spearfish. And this is a new area. It's the first time we've developed this geological horizon as Saturn as a company. And I think what it did also is proved up the multi-zone development opportunity that our land has here. It's a very vast acreage of over 200,000 undeveloped acres of land. So it's keeping our geologists quite busy looking for new locations and where to bring the drill rig to. The other property I'll talk about in southeast Saskatchewan that came with the Ridgeback acquisition is this Viewfield property. This is a light oil again, but typically a little bit tighter of a reservoir. So hydraulic stimulation has typically been the way that people have unlocked the vast oil that's locked in this resource play. But what's happened more recently is that from development of the Clearwater play in Alberta, which is also a tighter formation, what some operators have done is a new drilling technique where they drill one vertical well bore and then expand that out into 6 to 8 horizontal legs to each well. They're unstimulated, which reduces the drilling and completion costs. And what they're finding out is that it's a very good technique to drain vast areas where the rock's a bit tighter and the oil's a little bit harder to recover. But the industry has shown, as they move this technique into our area, some very good IP rates. A number of wells have been over 200 barrels a day, very economic. And so this is something that we're putting into our drill mix this year. So we'll have a few of those to report back to our shareholders, and looking forward to seeing the results of higher ultimate recoveries and better economics of drilling up the Bakken. And as this works out, we have over 100 locations that are unbooked that we can add into our inventory going forward. I spoke about this Cardium asset. This is right in the middle of the fairway of this big Cardium play that's one of the hottest plays in Canada and one of the most economic. This gave us a very good package that has over 138 locations. Those are booked. We have our own ideas going forward, a couple decades worth of drilling inventory here. And we just put in 3 Cardium wells in the lock-in area. That's the map on the right. And we're using new drilling techniques of this extended reach horizontals. One of the well bores had a over 3-mile horizontal reach, and these really increase economics and oil recovery of this light oil resource. So a fantastic add to our mix, and something that we'll be back here developing later in Q4 and for the upcoming years, and has some really good drill results that we expect to put out to our shareholders here in Q4. So I spoke a bit about the drilling performance that we have had. It's the lifeline of oil and gas companies. When we make our investment, we need to get a fast payback of that investment and a long-term great return. And so far, our drilling this year has been quite outstanding. I talked about the spearfish drilling that was 33% above our type curve. Our Oxbow wells were above expectation as well. We had 5 of them earlier in the year, and in Q1 we also were developing our Viking property with over 100 barrel per day IPs as well. So all in all, about 37% above our internal guidance and expectation. Great wells. We look forward to continuing that success into the rest of the year. We're a little back end weighted in terms of our capex. During the first half of this year, when oil was averaging less than $75 US a barrel as a WTI price, we invested $33.5 million into capital development. We're going to almost triple that amount. We have $96.5 million of new wells and new development slated for the back half of this year. So that should set the company up very nicely for a strong exit rate for 2023 and a great beginning for next year. And we expect that we can continue to grow production at a modest basis, all the while directing most of the capital back towards paying down debt. We put out recently our guidance, looking to average the year at $80 WTI. The first half of the year is below 75 thereabouts. The rest of the year, I think we're going to maintain these nice oil prices. It's certainly great to see the oil price hanging in there at around $87. So on average, it should be $80, though didn't spend much time at that level. We'll do about 24,100 BOE a day as an average for the year. More importantly, we're looking at our exit. We'd like to be north of 27,000 BOE a day and set us up nicely for some more record quarters going forward. Like I said, that's about $375 million of EBITDA. We'll have CapEx about $130 million on the development side. It leaves about $145 million of free cash flow after deducting $10 million for some capitalized G&A. So that's our free funds flow. That's about $1.15 per share. Some analysts look at it on a free cash flow yield basis. We're at about a 40% free cash flow yield. And I think looking forward, we're probably just a little bit above that as well. So certainly there's a lot of cash flow back in the value of Saturn shares. We do have picked up 6 research analysts that cover the story. Happy to share that research with you. If you want to reach out to the company, I'll put some of that back to you via email. We just listed Canaccord Genuity's coverage universe. Mike Mueller covers us there. We're one of his top picks, certainly the highest expected return. You look at the bar chart on the right. He has a $5.75 target price, so he's expecting about a double out of the stock. Some of the other peers we have slightly smaller target prices, but we're quite happy with the confidence that Canaccord has shown in us. And one of the reasons they've come up with this recommendation is on the left-hand side, that's the 2024, their expectations of our enterprise value to debt-adjusted cash flow. You probably know that closer to a ratio of enterprise value to EBITDA, pretty similar metric, where Saturn is the one company in their coverage universe that's below 2 times EBITDA or debt adjusted cash flow. So certainly a lot of value there. Echelon Capital recently came out with a $5.65 buy recommendation, and we're their top pick in the oil and gas industry here in Canada. So nice to have that following. Again, yeah, delighted to share that with you going forward. And I'll just kind of flash on here that you can contact us at info@saturnoil.com. I check that inbox all the time. Certainly happy to answer any other questions you might have, and as well as direct you some of our financials or research, and as well as give you an update ongoing to our progress. So I will then take a look at some of the questions here. Take some of those here now. They're starting to add up here. Well, here's the first question. Soil looks to be undervalued versus his peers. What do you believe that is? And what are the catalysts for a revaluation of Saturn? So, yeah, that's a great question. I would say that for ourselves, looking at what some of the analysts have said is, I'll say one thing. We are a relatively new company. If this is the first time you're hearing of Saturn, I'm not surprised. We talked to some pretty sophisticated institutions in Toronto and New York that are supposed to follow the oil patch. And a lot of people haven't even heard of Saturn yet either. We've had a pretty rapid increase to our production base and certainly our market capitalization. So we're a little bit of a newer name on this story. I think that hopefully the OTC and these kind of conferences will help us reach new investors. We'll see the value here. But on top of that, we also do have, I would say, a little bit higher leverage than some companies. We're certainly looking forward to reducing that leverage going forward. And I think there's some industry pundits that think that could be a revaluation and a re-rating for us, a chance to take the stock price higher. Now, mind you, from my own point of view, if we keep just paying down the debt and maintain our enterprise value, I think there's a backfill to our equity value as well. Every dollar we pay down a debt should be another dollar back to the unit holder, so to the equity holder, sorry. So from that point of view, I think there's upside even if we don't get a re-rating. Got a question here. How are you thinking about your capital structure? Would you refinance your loan or just pay it off over time? Yeah, that's an important question. I think it's on the same line. We are paying down that debt as fast as possible. Get 60% of our cash flow. So that's one of our number one priorities, besides drilling great oil wells. But at some point in time, I think we'll get our debt levels down. Certainly, we'll look to be around 1.2 times EBITDA by the end of this year. And when we're somewhere in that range of 0.7, 0.8 times, I think that the leverage levels are quite manageable over the long term. And at that point in time, we'll probably reduce the amortization of the debt and free up some of that free cash flow towards other ways. And certainly a shareholder return model is something we're considering at the board level. We have no mandate for that now, but there would certainly be enough free cash flow for a substantial dividend. Got a question here. Has the strength of the U.S. dollar hurt Saturn as a Canadian producer? Um, yeah, actually, kind of quite the opposite. I think I'll probably, if I flip back to this slide here, we have been enjoying some very nice margins from the increasing oil price. Now, oil's down a little bit now from even where it averaged last year, and of course, reduced operating costs helped. Reducing royalties also helped. But the strength of the U.S. dollar has been one of the things that has been the tide that's been rising all the boats here in Calgary. Canadian producers, we basically get paid in U.S. dollars. And so in 2022, the average exchange rate was probably $1.25 Canadian for every U.S. dollar. We've been closer to $1.35 Canadian for every US dollar here in 2023, which just means in Canadian dollars, we're reporting more revenue, and our cost structure is all in Canadian dollars, so that helps our margins. And yeah, the Canadian dollars, typically gets stronger as oil prices go higher. There's a strong correlation to that looking backwards, but yeah, the US dollar has been fantastic for Saturn and most Canadian companies. And on top of that, now with this strong U.S. dollar, and you get to buy probably more Canadian oil and gas shares with your strong dollar as well. So there's a couple benefits to that. One question here: what is your institutional shareholdings estimated at? It's difficult to track. Certainly, we can track at the institutions that have been buying our shares, and certainly in the last few offerings that we've been raising money to make acquisitions, we've been at 85, 90% institutional on our share raising. So I think if I kind of blend that in with where we were before, because we were largely mom and pop shareholders when we just got going a couple years ago. So we're probably around that 65% institutional and 35% retail, although retail is a pretty important part of our shareholders, and that's kind of, we've been seeing increased liquidity certainly since we moved to the TSX main board, and even in the US, quite a bit more liquidity as well. As I can see, there's a lot more US shareholders coming on. I think that we were up, the second half of this year is already up 80% in trading volume versus first half of the year in the US side. So we do appreciate that. I've got a further question. Has management been buying shares? So that's something that the industry tracks here in Canada. You can go on the SEDI, SEDI website, and you kind of track the buying and selling, and it's only been buying of shares here by our management team. I myself am a serial buyer of Saturn shares when I first came in as an investor in 2021. I bought on the last 4 equity raises and looking to buy some more, certainly. Our CEO, in fact, our whole management team for all the last 4 equity offerings has been buying shares in sizable amounts. So, yeah, we feel that we're pretty aligned with our shareholders, shoulder to shoulder, in terms of our reward will come through share price appreciation. Definitely. Can you provide some of the background on your management team? That's a great question. I'll slide here forward to our team. So our company is run by John Jeffrey, a terrific entrepreneur. He's the one that took over this company in 2017 and set its sights to, in a previous iteration, Saturn Minerals, the company itself was unrelated to its current business model and its current management team. And so he took over the company and basically, started growing this as an oil and gas company. Scott joined with me a couple years ago. Justin's been here since the start, one of the top geologists here in Canada, a proven oil finder, and more recently, Grant McKenzie, who is now our chief legal counsel, joined us from Denton's. He's been with us from the start as a professional advisor and on our growth here. So solid group here, and we're looking to take this company going forward. I mean, I'd say certainly we're Canada's fastest growing oil company, and I also think we're the most undervalued. So I encourage you to take a look at Saturn. Thanks.